Walter, thank you so much for being here this morning. Thank you.
Thanks, Eugene. Okay, good morning, everybody. And as Eugene said, last push before a break. So I'm going to talk to you about multi-asset, but actually it's not going to be that much different to what you've heard probably all morning. And that is all that glitters is gold, or at least on the Johannesburg Stock Exchange, but also in many of the other markets. So some of the drivers of gold, the major macro uncertainty that arrived in the world with Donald Trump. His tariffs on, tariffs off, dealing with partners on a transactional basis, seeing what is good for the US, and then just changing his mind on a very regular basis has created a huge uncertainty in capital markets. And it's something that's not going away, where investors were typically seeing, investors and countries were seeing the US as a safe haven. This has damaged the psyche of these global investors, and it's going to last for a while. And he's not done. He's busy meddling with one of the most important central banks in the world, the Fed, and implications of that can be further dislocations in the markets. So all of this has meant that there's been a recalibration of what was thought to be safe haven assets. The US dollar in the past was the go-to currency when things were going wrong. People were parking their money in dollars and treasuries, and this has already started to change, but this is going to carry on for a while still. And also the size of the US market, the size that has been over time that's been accumulated in these US assets, makes that even a small shift away from US assets causes big dislocations in other markets. And that's why we're seeing these strong rallies in the likes of gold. And in the past, if you go back over time, gold has had quite a low correlation to other asset classes. So it didn't move the same way, and that helped it as a asset class of safe haven assets. Recently, its strong performance has actually coincided with what is happening in equity markets. So this is in broad terms what I'm going to talk about, and I'm going to expand on some of these thoughts. Just again, something about us. I'm Walter Jacobs, CIO at BlueAlpha and also a portfolio manager. We've been around since 2003, and we run a number of multi-asset funds and equity funds, both local and global. I'm not going to dwell too much on this. I'm going to get to just how we go about things. So asset allocation, we've always felt that tactical asset allocation doesn't really add value over time. There's actually very little evidence that supports that over time somebody can tactically allocate consistently well. Although if you can time it, there is no question that can add significantly to performance. So we utilize what we've seen in the past as being good asset class performance, and understand where we need to allocate based on that. And we use the strength of our equity franchise as the building block for that. And we just believe that we manage risk slightly differently to the big guys, where the big guys will go for bonds, typically as a diversifier away from equity. We typically look at things like gold and commodities. Our investment philosophy is typically bottom up. So we'll describe ourselves as a quality manager with a growth tilt, and the thing that we care about most in valuations is free cash flows, and I'll talk about that when it comes to the gold sector. And we're not macro forecasters. That doesn't mean that we don't care about macro. We just don't forecast macro. We observe what's currently going on and then understand what is the risks and adjust portfolios accordingly. So this is just a study that was done by SBG, so Standard Bank's equity department. And this looks at asset class performance in a South African context from 1976 to 2024. And what you see here is various time frames. So the table on the right is various time frames that they're cutting it. And they're looking at asset classes like equity, property, gold, inflation, and bonds. And when you're looking down the table on the right and you look at gold, you see that in a number of years, gold has a 1 next to its name. That means it was the best performing asset class in that particular year. Now, this gold that they're talking about here is a coin. So it's the rand price of gold. So 2 components, the gold price in dollars and rand. So it's not the gold companies, it is the gold ETF, you could even say, as a proxy for that. And what we can see is that gold is consistently ranked one of the better asset classes for a South African investor. Now, if you went back 2-3 years and looked at the study, gold wasn't as prominent, but it was still one of the top 3 asset classes. So the recent strong performance has obviously pushed it to the top and has even impacted the long-term performance. But as I said, if you go back 3 years, you would still find it in the top 3. And so gold is really something that we believe that an SA investor cannot ignore. And a number of speakers has mentioned this already, is just what has happened to gold and platinum in the indices. And you can see that 5 years ago it was a lot larger, became quite a bit smaller, and gold specifically has significantly re-rated in terms of its size in the index in this year. Now I've got now there, but that now is at the end of August, and both gold and platinum, because of price movements and corporate actions, has already been upweighted again in the indices during September. So it's really at plus 20%, something that you just cannot ignore, and therefore something that you should pay close attention to. And what I've just showed here is BlueAlpha's multi-asset funds. And then what I also did is I looked at the fact sheets of the major players in the multi-asset space, in the multi-asset space on the CISA categories, as at the end of June, obviously. That's when we have these fact sheets generally available for everybody. And it's the four big players. And you can see that their exposure is quite a lot lower than what we have at BlueAlpha. And as I said, we typically do not play as much in the fixed income space as these other players would. We use gold and precious as the offset for equity risk. So, is this just something that's completely away from our process? I said we're quality managers with a growth tilt, and what I'm showing you here is the cash flow return on investment. So that's just how good a company generates cash flows from its operating assets over time for the gold and precious sector. So it's the large gold companies and the large platinum companies aggregated, their cash flows relative to the assets that they have. And what you can see is over time, these are cyclical value creators at best. So cyclically, they are quality businesses, and clearly over time, there is also a cyclical element to growth. And what we can see is that these trends can typically sustain for quite a while. So it means that when this trend in gold goes away, we're going to have to be very careful about what happens to these companies' profitability. Because as you can see in the earlier part of this chart, there is a significant period where those bars are declining, and they're below the red line, which is the long-term cost of capital. And during those periods, gold will significantly underperform. And we've seen it in the past. We've seen that these gold counters underperform significantly, and the likes of Sibanye-Stillwater has been taken to the wall and had to issue stock, and similarly with Harmony. But right now, we're in a very strong upcycle. The reasons for this upcycle is probably going to prevail over time, and it's not just in gold, it's in platinum. And so what we're just showing here is the deficits in the platinum market, and that's one of the reasons that's supporting this price. And we think that these negative supply-demand dynamics or the shortages in the platinum market is going to prevail. These miners have not invested in bringing mines up to or expanding mines, and although there is weaknesses in the auto market, just the contraction in the in the platinum mining space is going to allow for this price to sustain, and we believe the performance to sustain. Various speakers spoke about dollar and the de-dollarization of safe haven assets, and this is just another chart that speaks about that. It's been ongoing for a while, and as I mentioned right up front, we don't think that the reasons for that is going to go away. We've seen this surge in central bank buying. It's mostly been from emerging markets, but there is scope for some of these other larger central banks also to get involved. And what this chart wants to demonstrate is just if spot prevails where we are right now, there is still some significant earnings upgrades that need to happen. So the market analysts looking at these counters have not factored in the full benefit yet of these prices. And so what you see, that blue circle is for the platinum counters. So there's most upside to earnings if spot prevails for the platinum market. For the gold market, because that's gone on for a long while already, not as much upside, but still upside to earnings. And then finally, for the rest of the material space, there is actually probably more downside to earnings. So the bottom circle that you see there, that bottom gray circle that you see there, that's Glencore. And there's still downside risk to its earnings, predominantly from coal. And the top right, the blue circle there, that's Sibanye-Stillwater. Obviously, it has both gold and platinum exposure. So a very different materials sector that we're seeing in SA, where precious, and people have showed that, where precious metals have done all the running, but we believe more legs to come, because if spot prevails or even go higher, there is still going to be upside risk to earnings. So yeah, just in conclusion, we think that the factors that has driven this rally in precious metals is sustaining for probably the next 3 years. There is deficits in the platinum market. There is weak supply in autos, but that deficit is gonna prevail, and that will sustain the price. And what we have ongoing in the U.S. with Donald Trump and the way that he's reacting with all of his trading partners, and just the damage that does long term to people's perception about can you really trust the U.S. To be the go-to place in the past is just going to last a lot longer. So we remain overweight these sectors from a multi-asset perspective as well. Thanks, Eugene.
Thank you, Walter.
And maybe I forgot that. So this is a quote from Goldman Sachs, that even if just 1% of privately owned U.S. Treasury, so this is not the central bank market. The private market actually is a lot larger in U.S. Treasuries. And if 1% of that shifts to gold, they say it can go to 5,000, and there is others that have a $6,000 target price. So again, I know it's a consensus thing, but sometimes consensus can be right.
Second time this morning, we're hearing 5,000. It's starting to sound like an auction, isn't it? But Walter, we've got very good ideas as to what worked and your views going forward. But just very quickly, the past 12 months, what did not work, and did any of your positions change? Yeah, so going into 2025, we came off quite a good 2024. And we were, as some of the speakers had said, we were in the likes of some of the banks, local banks, the retailers, and specifically in the retail, we were hurt. But we've cut down on those positions and in favor of the golds. Just number of speakers mentioned the GNU and where we're going, and it's just going to be tough. We need, as we've said, changes in the country. I mean, if you look at what's happening specifically in our area, Gauteng, I mean, what you have is rates and taxes continue to go up, service delivery going down, potholes going down, Joburg water. So these things are really impacting not just people's psyche, but their pockets. And so these retailers are just going to take longer to recover, and you're going to have to be very selective in that. And there is no growth in those companies. So if you look at share price earnings growth, you're probably looking at 5 to 10%, and you're getting 200% in platinum. Like there's just no comparing what's happening. So yeah, a shift from the retailers specifically into the precious, and just lightening some of the banks' position, but we're still overweight banks. Cool. Walter, thank you very much.
Thanks, Eugene.
Oh, Walter, sorry, there's one question from Pierre, yeah?
Hi, Walter. Pierre de Klerk from Apex. Can you just quickly talk about your global geographic makeup? Historically, you've been quite heavily invested in the US, but last time we engaged with you, you kind of did say or did hint at the fact that you're looking elsewhere. Obviously, you're also observing the valuations and the concerns around the US that everyone else is. So have you made any significant changes in your geographic exposure in your global portions?
Yeah, thanks, Pierre. I mean, 100%. That was the thinking. But what I will say is that in the US, I mean, you still have a very, very dynamic market. With AI specifically and the way that capital is allocated, you just do not see that elsewhere in the world. And So we're believers that the US will lead the way in AI, and so we still have significant exposures there. And also, when you look at the companies that we invest in the US, the likes of Meta, etc., more than 50% of their revenues are outside of the US. So that's always one of the things that we point to, is actually have a look at the underlying profitability of these companies. A lot of them also have significant EM exposures. I mean, Apple, the iPhone, you just heard again with the latest release of the iPhone. I mean, China has ordered significant amounts of the iPhone, etc. But yes, we've made some changes. So Novo Nordisk, post its large slump, has come into the portfolio. We have Alibaba, we have Tencent, so on the China side as well, because some of the US tech has just become too expensive, and the likes of Tencent and Alibaba offer much more value for the AI exposure. Yeah. Thank you.
Thank you, Walter.
Thanks, Eugene.